Hi guys, welcome back. Today we will be having monetary policy. Monetary policy is changing the money supply to influence the nation's economy. This is usually performed by the central bank of a country. In our case, it would be the Bangko Sentral ng Pilipinas. Monetary policy would utilize open market operations, changing reserve ratios, changing the discount rate in order to accomplish the desired impact on GDP, employment, and price levels. To understand how this works, we should appreciate the relationship between interest and the quantity of money demanded. Basically, interest is the price to be paid for the use of money. There are at least two types of demand for money. We have the transaction demand. The transaction demand is the demand for money for use in the exchange of goods and services, such as buying and selling. Note that this is not influenced by the change in interest rates. The other demand for money is the asset demand, which is the use of money as a storage of value. In this case, we are going to have an inverse relationship between the quantity of the money demanded and the interest rate. The higher the interest rates, the lower would be the quantity demanded for money. This is because we would rather pay off our debts if interest rates are high, or we would lend our money if this is the case, reducing the quantity demand for money. If we're going to combine the transaction and the asset demand, the total demand for money has a curve that looks like this. Again, interest rates are simply the price that we pay for the use of money, an inverse relationship with quantity. To fully appreciate how monetary policy would work, we also need to have an overview on some of the items in the balance sheet of the central bank. The central bank balance sheet is simplified to look like this for purposes of understanding the monetary policy. In the left side, I would like to highlight treasury securities. Treasury securities are basically debt instruments that represent government obligations. So if the central bank possesses them, they are assets of the central bank. Another asset would be loans to commercial banks. From the name itself, this is the amount lent to commercial banks, receivable from these commercial banks. And there are also other assets, which are not important for our purpose. To the right of the balance sheet, we would see treasury deposits. Treasury deposits are government's financing in the central bank, amounts contributed by the government of the country. Now, an important item to be discussed here is the reserves of commercial banks. This is basically cash amounts kept on hand by banks in order to meet central bank requirements. At this point, it is important to understand that any amount of cash in circulation in the economy is an obligation of the central bank of the country. So if you're going to look at a bill, you would notice that it is acknowledged that this is an obligation of the central bank. As such, reserves of commercial banks, which is again cash, is an obligation of the central bank. Now, what do we mean by reserves of commercial banks? Again, it is the cash amount kept on hand by banks in order to meet central bank requirements. This is to be appreciated together with the required reserve ratio. How does this work? To understand, let us make the following assumption. Imagine that we have an initial deposit in any bank, 100,000. The required reserve ratio, let us say it is 20%. How will the bank account for these transactions? Well, Initially, there would be a debit to cash, credit to deposits payable by the commercial bank. That would be 100,000. So if there's a credit of 100,000 in the deposit side, the left side of the balance sheet of the bank should also increase by 100,000, the same amount. If there's a reserve requirement ratio of 20%, 20% of 100,000 is required to be kept by the bank, maybe in the vault or somewhere else. So the reserve requirement would be 20,000, which is 20% of 100,000. What about the remaining 80,000? The remaining 80,000 can be lent to the general public. 80,000, if the entire amount is successfully being lent, we would find a loan receivable of 80K in the balance sheet of the bank. Now, if someone would borrow 80,000, he or she can deposit it to another bank. If that would be deposited to another bank, this time we have Bank B, there would be an additional deposit of 80,000. So what happened here? Banks create money out of thin air. If we deposit an amount, the bank can multiply that money through this system. So if someone would borrow 80,000 and deposit it to another bank, that bank will have to maintain 20% of the amount, 80,000, as reserves to be kept within the bank. 16,000, which is 20% of 80,000. Now, this bank can again lend the remaining 80%. 80% of 80,000 would be 64,000. And then, whoever borrows 64,000 can again deposit this in another bank. This is how the banking system works. So if this trend would continue ad infinitum, how much will our initial 100,000 will be? Well, we can calculate this by dividing the initial deposit by the required reserve ratio, which is 20%. 100,000 divided by 20%, a total of 500,000 will be in circulation throughout the banking system. At this point, it is clear that it is actually banks who create money. Moving on to monetary policy. Monetary policy can be accomplished through the following: open market operations, which is simply buying and selling of treasury securities, changing the required reserve ratio, or changing the discount rate. In open market operations, the central bank would buy or sell treasury or government securities from or to commercial banks or the general public. So under open market operations, take note of the balance of treasury securities and the reserves of commercial banks. Again, these are obligations from the point of view of the central bank. Let us assume a 40% reserve requirement. This would be an illustration as to how the money supply can go up or go down by buying treasury securities. If the central bank buys treasury securities, say for 1 million pesos, the left side of the balance sheet, treasury securities, will go up by 1 million. The reserves of commercial bank, which is basically cash, will go up by 1 million. This is on the right side of the balance sheet of the central bank. But for the commercial bank, this will be found on the left side. Again, this is simply cash. So treasury securities will go down by 1 million and the reserves of the commercial bank would go up by 1 million in the books of the commercial bank. If our reserve requirement is 40%, then the money supply will go up by 1 million divided by 0.4. That's 2.5 million. By buying treasury securities, the central bank can increase the money supply. If the central bank would buy it from a company, the company's balance sheet will experience a decrease in treasury securities by 1 million and an increase in cash by 1 million. Considering that most cash is deposited in banks, this would pave way to an increase by 1.5 million in the total cash if we're going to follow this system. As a result, the end product, we will also find a 2.5 million increase in the money supply. What if the central bank would sell the treasury securities, say for another 1 million peso? So the central bank's balance sheet would experience a 1 million decrease in treasury securities, left side, and decrease in the reserves of commercial bank by 1 million on the right side. In the balance sheet of the commercial banks, 1 million peso increase in treasury securities and a 1 million peso decrease in the reserves of the commercial bank, which is again cash. Again, if the reserve requirement ratio is 40%, then the money supply will go down by 1 million divided by 0.4. That's 2.5 million. Similar story can be said when it will sell to companies. In the balance sheet of the company, this would be a 1 million peso increase in treasury securities and a 1 million peso decrease in cash. Considering that cash is generally maintained in a bank account, a decrease in cash by 1 million, given a reserve requirement ratio of 40%, will also decrease another 1.5 million in the bank's ability to create money, thereby resulting to 2.5 million decrease in cash. This is what we call open market operations. When the central bank buys or sells treasury securities from or to banks and companies, the money supply can be altered. Another way to conduct monetary policy is to changing the required reserve ratio. In our example with the initial transaction of 1 million peso, if the reserve requirement ratio will decrease from 0.4 to 0.2, the money in circulation in the banking system, from 2.5 million, it will become 5 million. On the other hand, if we increase the reserve requirement ratio from 0.4 to 0.5, that same 1 million from 2.5 million will only become 2 million. This is how we can influence the money supply by changing the reserve requirement ratio. Another way to influence the supply of money is through the changing of the discount rate. Discount rate is the interest charged by central bank to commercial banks. Naturally, if the central bank will decrease the discount rate, the commercial banks would be motivated to borrow more, hence increasing the overall money supply. On the other hand, if the discount rate will be increased, commercial banks would be discouraged from taking a loan, thereby decreasing the reserves of commercial banks. At this point, we can summarize the tools of monetary policy and classify them: expansionary or easy money and contractionary or tight money. Expansionary monetary policy has the intention to increase the money supply. This can be accomplished when the central bank buys treasury securities, decreases the reserve ratio, or decreases the discount rate. Meanwhile, contractionary monetary policy has the intention of decreasing the money supply. This can be accomplished when the central bank sells treasury securities, increases the reserve ratio, and increases the discount rate. So how can this have an impact on the overall economy? In expansionary monetary policy, the increase in money supply would translate to lower interest rates. More money in circulation, the lower will be the price of borrowing such. Lower interest rates. Lower interest rates would translate to a lower cost of capital for private firms. If the cost of capital is lower, more investments will be made by the private sector. If there's more investments, this would increase the aggregate demand through the multiplier effect, thereby increasing a GDP, thereby increasing the gross domestic product. An expansionary monetary policy, also called easy money, is utilized when the economy is under the threat of a recession. To mitigate recession, we can do expansionary or easy money policy. Meanwhile, if we do contractionary monetary policy, there would be a reduction in the money supply. This reduction in the money supply would increase the interest rates. Interest rates being priced for the use of money. If interest rates would go up, the cost of capital for private businesses would also go up. So the private sector would reduce their investment. Lower investment would decrease the aggregate demand through the multiplier effect further. As a result, if ever there is a demand pull inflation, that would be mitigated through this system. This is how expansionary policy and contractionary policy works. Expansionary policy basically is used when we are under the threat of a recession, while contractionary monetary policy is being used when we are under the threat of demand pull inflation. Issues in the monetary policy. Compared to fiscal policy, monetary policy is fast and flexible with no political pressures, considering that monetary policy is being done in the central bank. Congress or the office of the president will have less influence on such a policy. However, monetary policy also has lags. It includes recognition lag. Remember that recognition lag, there is a delay when an event such as a recession happens before we recognize it. And operational lag. For the policy to work, it would take time. But there is no administrative lag, no government bureaucracy when we talk about government bureaucracy being present in fiscal policy. There is, however, cyclical asymmetry. Usually, contractionary monetary policy would work. Contractionary monetary policy is basically pulling a string. Contractionary monetary policy is basically like pulling a string. When we want to depress spending in the economy, what we can do is to increase interest rates with lower money supply. Pulling a string is easy. However, expansionary monetary policy is like pushing a string. You cannot push a string. What you can do is to make it loose so that the producers and consumers would be able to respond. But it is no guarantee that expansionary policy would work. That is it for the monetary policy. Like, share, and subscribe.